Do the markets still care about U.S. inflation? Or have they already shrugged everything off, priced everything in, and we're just going to continue to go higher? That's the question we're asking ourselves on Macro Money today. Welcome. This is Ilya Spivak, head of Global Macro here at tastylive. And we have entered the part of the week where we are facing down the biggest piece of economic event risk on the calendar, U.S. CPI data. Now, it might have been easy enough, let's say 2 weeks ago, even a week ago, to say, well, of course the markets care about inflation. But with the recent developments here over the past 2 days, 3 days, really going back to Friday's U.S. jobs report, something of a sea change may be afoot. And so we're going to look here at why that might be going on, whether, in fact, the markets care, should care, will care to what comes out, and if so, how? And what kind of signal for where stocks are going, bonds are going, and currencies are going could be had, regardless of whether they care or not. Because, in fact, whether the market cares or doesn't care to whatever outcome occurs here is actually a signal unto itself and should speak volumes about where we are going next. So let's begin first with, why do markets care about inflation in general? Not just this release, not just this report, but inflation as a whole. Well, we know, because we just got the latest set of global Purchasing Manager Index numbers, which are an approximation for GDP. GDP tends to be fairly lagged and tends to be released quarterly. So you only get 4 GDP releases in a given year usually, and they tend to be very, very lagged relative to when they're actually reporting on. So you might get second quarter GDP data well into the third quarter GDP data well into the fourth quarter, and so forth. The PMI data tends to approximate where the trend in GDP is going in a much more timely way. It's released monthly. It polls purchasing managers, and so it's forward-looking, which makes this a good barometer on the global business cycle. And what we see from the latest round of these numbers from all across economies, developed and emerging, this is the catch-all. And we see that global growth has slowed to near standstill. The composite index, including both manufacturing and services, is hugging that middle line at 50. Above 50 is growth, below 50 is contraction. The further you go above, the faster the growth. The further you go below, the faster the contraction. And what we see here is, of course, manufacturing has been in various degrees of contraction basically for over a year. But services had a nice pop at the start of the year that has now fizzled, and growth has retrenched to just a hair above that neutral standstill line. So we're growing, but at a very slow pace at this point. Now, from the market's perspective, how do you fix this? Markets don't like slow growth because slow growth means slow earnings. And of course, what are stock markets if not reflections of investors' expectations for future earnings? So what we're looking at here is obviously a concern if one is generally expecting or wanting to see, as most market participants do, because markets are biased long to some extent, certainly in equities. What you see is a concern and a desire for some sort of counter narrative, some sort of positive thing that helps to push this in the other way. The most natural thing, of course, considering the way we got here in large part, is thanks to central banks' inflation fighting efforts, primarily led by the Fed, which have been raising interest rates aggressively to cool inflation that perked up after COVID for all kinds of reasons, temporary and sticky. Temporary when it comes to supply chains, sticky when it comes to wages. Central banks responded by raising rates to try to make borrowing costs higher, to try to slow economic growth, which incidentally is exactly what we're seeing here, to try to get inflation down. Ostensibly, with growth now at standstill, the markets might argue, it's time to let up. It's time to loosen the screws. It's time to start reducing interest rates. And of course, the spotlight falls squarely on the Fed. Because if there were one thing that could be done to boost economic growth, it would be the Fed to do it. There is, of course, a tremendous amount of complicating factors when you get into fiscal policy, which is government spending or taxes. First of all, that's aimed locally at whatever economy you're talking about. Second of all, there's political infighting and agenda building and differences from one country to another that complicate all of this part of it. The Fed is a single point of support. Because on the monetary side, not the fiscal side, it really is the Fed that matters. And this is why. The US dollar absolutely crushes other currencies in terms of volume and turnover. It is by far the unit of commercial exchange for the global economy. I highlighted the BRICS grouping there collectively just so we can see just how paltry these currencies are in their turnover numbers relative to what we see in the dollar. And by the way, as we can see here, most of them are China. Most of that BRICS bar is China. I point this out, of course, because recently we've had conversations about the dollar somehow being displaced by a BRICS currency, which of course is a ludicrous idea when we consider just how much turnover you would have to fit to squeeze that dollar bar into the BRICS one. It's not anything workable. But what this means is that when the Fed increases or decreases the cost of borrowing dollars, ostensibly with domestic economics in mind, what it's doing is it's actually increasing and decreasing the cost of borrowing the unit of exchange of global commerce. And so that's impacting interest rates everywhere. So if there was a single point whereby the markets could get a reprieve without muddy international political complications, it would be the Fed. But the Fed does not want to relent. In fact, we just got minutes today from September's FOMC policy announcement. This is the summary of economic projections that the Fed released with that policy announcement last month. We can very clearly see here the Fed's intent not to relent on rates in any kind of rapid fashion. So we can see here GDP expectations revised higher from 1 to 2, from 1.1 to 1.5. Unemployment expectations revised lower from 4.1 to 3.8, from 4.5 to 4.1. Inflation either higher or steady, especially for next year. And against that backdrop, rates higher. In particular, next year, when the cuts are due to begin, we can see before the expectation was a climb down from 5.6 to 4.6. Now it's 5.6 to 5.1. So the Fed is very clearly saying, we anticipate 50 basis points or half a percentage point fewer rate cuts for next year in September as opposed to June. So with the benefit of seeing 3 more months of data, which, by the way, only saw global growth slowing further, as we just saw. It's not as if the Fed had positive news, at least on the global economic side of things. Here's those last 3 months right here. With the benefit of having seen this 3 months of information here, the Fed said, yeah, actually, we're going to hold rates higher for a longer period of time. So this is the central conflict, and this is why the markets care, because obviously they want cuts sooner, it would seem, and the Fed doesn't want to do that. Which means, not surprisingly, that the markets are displeased and concerned. Now, where is this disparity coming from? Here's the makeup of inflation and what we're expecting to see for September's numbers. We have here goods inflation, the lighter blue area there in the middle, squeezed down to next to nothing. The energy component is actually at this stage, and we'll see what it looks like for September, but as of the latest data, it is actually negative. It is actually pulling inflation down in year-on-year terms. And in fact, what we see here over the past 2 months is a rising price in crude oil has increased headline inflation, which includes energy and food, but core inflation here has continued to come down. Because all that this pop seems to really reflect is this becoming less negative. But needless to say, the elephant in the room here is this right here. Services excluding food and energy. This is where inflation lives, as far as the Fed is concerned. This is how it is going to get inflation down, getting that service sector component to head lower. Now, what is that service component made up of? So we can see it is overwhelmingly the price of housing. Now, what can the Fed do about the price of housing? Is there anything that the Fed can do with raising or lowering interest rates that can impact this? Well, theoretically, sure. But the reason these purple bars are so giant and the reason that they've held inflation up for so long is ostensibly the Fed's own doing. Here's why. The average interest rate on outstanding mortgage debt in the United States is 3.6%. That's because most people lock in their mortgages for a 30-year period in the United States. That's, by the way, different than it is in most other countries. But in the U.S., we have very long-term fixed-rate mortgages available. And so most mortgage debt is locked in at far lower rates than what is currently available in the market, which is about 4% more expensive. And so, not surprisingly, owners of homes are not exactly eager to sell. Because if they did, their next home that they would be ostensibly moving into would call for financing at a much higher rate. And so most homeowners, even ones that might have been minded to sell under different circumstances, it looks like, are biased toward not selling, toward staying in their homes. And what that has done is it's essentially reduced sellers to a point in the market where inventory has collapsed to the lowest levels in decades. And so the price can't come down. If there are no sellers, how is the price to come down? So it is the Fed's own rate hikes that have pushed mortgage rates as high as they have, that have essentially created illiquidity in the housing market and that have created this shelter component in all of its grandeur. So this is not a place where the Fed can ostensibly have agency because, of course, if it were to start to cut to unstick this, it might also let inflation expectations out of the bag and shoot itself in the foot. So the Fed has to make the markets credibly believe that inflation is going to continue to decline before it cuts, and the way it has to do it is not this. Well, that leaves the Fed with the labor market. Now, in the labor market, we can see that the employment cost index in the yellow has fallen much less off the peak, down from 5.1 to 4.5%, than the decline we've seen in core or in headline CPI, which we can clearly see here have fallen much more off the peak. That would be that goods inflation getting squeezed to next to nothing. But the remaining component is this services component, and in that services component is this labor component. And this labor component is very clearly not falling like all of inflation is, or at least to the same vigor. And the reason seems to be this persisting deficit of workers in the labor market. As we can see here, labor supply minus labor demand has been negative really since about the middle of 2021 on the way out of COVID. It, of course, was tremendously tilted in the opposite direction during COVID. You can see the spikes there in early 2020, much more labor supply than labor demand because, of course, we have lockdowns, people are being laid off, people are being furloughed, businesses are closed, nobody can go anywhere, lots and lots of surplus labor. As things start to reopen, that surplus is driven down, but of course then inflation is also driven up because there is increasingly competition for this labor. And how can businesses compete for labor that is scarce? Well, only on price, which in labor terms is wages. And wages don't easily adjust back down when inflation cools. The price of eggs, the price of milk, the price of gas, the price of all kinds of things might well adjust down as inflation comes down, but wages typically get locked in. And so now there is this inflationary increase that's baked into the labor market. And that, of course, makes everything have a price boost to it because it takes labor to do whatever it is that businesses are looking to do. And so if that labor is now more expensive, they tend to pass that on to higher prices for consumers. So from the Fed's perspective, the place it can actually have agency to act is here, where it can keep the costs of credit high, try to encourage layoffs, and try to not encourage so many of them that there is some sort of a tectonic, ugly recession. But to try to slow economic activity such that there are enough layoffs, that there are wage agreement resets that squeeze baked-in inflation out of the labor market, get the process going in some sort of a sustainable way, then unlock rate cuts that bring down things like illiquidity stuck in the housing market and reduce that part of it. So this is the Fed's calculus. Now, what do we see then for financial markets as these numbers come out? Well, we've just learned that the labor market is apparently hotter than the markets anticipated. We can see that actually we have been looking at 3 months at this point of accelerating jobs growth. Right here. At a time when the jobless rate has basically held steady. That accelerating jobs growth, as a matter of fact, has significantly quashed expectations for this latest release. Just last Friday, we got September's numbers, and what did we see? 336K against expectations of 170K. That does not suggest that the labor market is doing what the Fed wants it to be doing. And so the Fed might be reluctant to loosen the screws. Just a day earlier, we saw ISM Economic Activity Survey data for September, and it showed us that the price structure in the service sector was at the very least steady at a 4-month high. The analog PMI data set from S&P Global, which is just another version of the same kind of data, showed that service sector inflation actually accelerated in September to the highest level since July. So either way you slice it, service sector inflation here looks to be on the up in recent months, perhaps reflecting this buoyancy in labor, perhaps something else as well. But if the Fed's focus is to cool inflation, to bring down the pace of price growth in the service sector, well, the past 3 months would tell you that all of that isn't going the Fed's way. Labor markets have been stronger, and the price structure in the service sector has been giving you accelerating prices, not decelerating. So, not surprisingly, the Fed came out, as we just saw, and gave us in September a policy announcement that said, look, we're going to have to hold rates higher. Markets, not surprisingly, didn't like it. We can see here in the gray bars diminishing rate cut expectations between November of this year. That's the first of the 2 meetings remaining for this year. We have November and December left, looking out through the end of next year. And we can see that at about mid-year, we were looking for close to 1.75 to 2% in cuts. We got to as low as about 75 basis points. And we can see here that when the Fed makes that announcement showing that their bias is to higher rates, as we just saw, stock markets go down. Scope for rate cuts decreases further, and stocks fall. And then on Friday, when that very buoyant NFP number comes out, something changes. And stocks start to go up. You can see here that's where the S&P actually turns and confirms its low, at least for right now. So what happened there? Well, here's that jobs report, and we can see, not surprisingly, stocks fell, just as we might expect. If the market is concerned about recession, and we get data that lets the Fed hold rates higher for longer, as we just saw, based on its calculus, focused on squeezing the labor market, well, that should be negative for stocks, because that means they don't get the help that they want from a less hawkish Fed. And the initial response is, as you might expect, stocks go down. They pause, they digest, and then they pointedly rally in the opposite direction. As if to say, I recognize what I should be doing based on what I have been doing. Now, here is the demarcation line for where I'm doing something else. And we end up seeing a shrugging off of this data. We then, of course, have a weekly opening gap lower around the horrendous atrocities that we're seeing with Hamas's attack on Israel over the weekend. But the markets ultimately shrugged that off as well in the same day. This is just Monday's price action. And so what we see here is a market that seems to be saying, we're not going to take better data here necessarily to think that the Fed is going to hike again or delay longer. That much we've already priced in going back to September's meeting. We're on to something else now, and that something else is generally risk on, because we can even shrug off this event risk from the geopolitics side back to back with risk from the Fed side. And so this is where things get interesting. If, in fact, this resilience in the labor market and this resilience in service sector inflation means that we are going to get an upside surprise on inflation for this September reading. And, of course, the most important way to get it will be for that core number. In other words, for it not to come down to 4.1, but register higher. And then whatever happens at the headline might be a wash, because, again, the markets care about this to the extent that it drives the Fed, and the Fed can't do much about food or energy inflation, at least directly. So the key issue is core, because that's where this service sector component really dominates. And so if that core number, for all the various reasons we've discussed, strong jobs data, strong pickup in service sector pricing based on the ISM and the PMI numbers, if all of that comes together to a higher core CPI number than anticipated, the key question will be, do the markets then sell off, or do we get what we got with NFP, which is the markets wobble, but ultimately say, we don't care. And the reason we don't care is because we've already priced this in. This doesn't change the ballgame. So however this works out, if the numbers come down and markets rally, well, then that's perhaps even a weaker signal, because that might be as expected. But if the numbers inch up, as some of these initial indications suggest, if only at the core, and the markets still drive bonds higher, still drive stocks higher, that would suggest that there is a very strong signal that the trend reversals that we've been looking at in those markets still have legs to continue going. And that is Macro Money for today. Thank you very much, as ever, for joining. If you're watching this on YouTube, jump into the comments, share your thoughts about where you think inflation is going, where you think stocks and bonds are going, whether you think that inflation matters for where stocks and bonds are going, or whatever else is on your mind, and we'll incorporate it into the show going forward. Macro Money is, as ever, here every week, Monday through Thursday, right after Overtime, a show that I co-host with head of futures and Forex here at tastylive, Chris Vecchio, and increasingly with the great Dylan Radigan, where we break down what happened in markets on a given day and try to figure out what might happen next and what tactical approaches we might take to benefit accordingly. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights section of tastylive.com, and opining on the platform formerly known as Twitter at Ilias Pivac. Thanks very much for joining. Happy trading. See you tomorrow.